Real and sustainable wealth is a function of garnering quality information and acting on that knowledge. Investors need well-organized, accurate facts and figures to assess a security for its potential return on investment. Hi, my name is Dave. As an accountant with 33 years of experience in reading and understanding financial statements, my role is to present to you a clear, understandable business model and the financial results of the companies featured in these videos. This episode is about McDonald's. This company is the standard bearer in the fast food industry. Their business model has dramatically changed over the last 20 years. McDonald's is driven by its mission of making delicious, feel-good moments easy for everyone. At the forefront, it appears to be about serving food. In reality, its business model is focused on real estate. This shift in business practice has dramatically improved profitability, ensured stability, and increased its resiliency against economic downturns. Simply stated, McDonald's is rock solid with its financial results. This is the first episode in a series about various members of the publicly traded fast food industry. It starts out with the largest and most dominant member in this industry pool. During this episode, I promise, 1. You'll learn how to read McDonald's income statement and corresponding notes to understand how real estate generates 54% of the company's net profits. 2. Why this shift in business model assures future profits and provides a defensive posture against recessions. I'll even calculate expected profits over the next 10 years. 3. I'll prove to you that the board of directors is highly focused on shareholder returns. I'll do this by reviewing the shift in value tied to the equity section of the balance sheet. I'll show you how to properly interpret the information presented in the balance sheet and to see how the company is intensely focused on returning 100% of its earnings to shareholders. And finally, I'll provide an investment matrix so that you can form your own buy-sell model for McDonald's that will benefit you for the next 5 to 10 years. Throughout this presentation, there are 3 links. 2 of them are downloadable PDFs to assist you with understanding these 4 key points. All 3 links are below in the episode's description. I encourage you to click the links, go to the 2 PDFs that are printable, download them, put them up on your screen as we progress through this episode. Before I start, I want to reiterate how much I believe in this company's strength as a top-notch operation. First, it has total sales exceeding $130 billion per year. It serves 70 million customers per day. It has 44,000 restaurants, and the company has not recorded a loss in the last 42 years. It is so strong. My wife and I purchased a single share in his name as a graduation gift for one of our sons when he earned his finance degree. McDonald's is a financial powerhouse, and this is why it is a member of the Dow Group of publicly traded entities. The economy is divided into sectors. One of those sectors is called the food service sector, and within the food service sector exists multiple different industries. One of those industries is called the informal eating out, commonly referred to as fast food. Costs associated with operating at the restaurant level are your food costs, here, labor, other types of costs, commonly like utilities, cooking oils, those types of things. You've got the facilities itself, which is the building structure and the parking area, debris removal, and so on. You have overhead, which is management. And then, of course, at the restaurant level, you have the interest and taxes at that particular location. McDonald's model, on their consolidated statement of income, you can see a good portion of all of this information. You have the company-owned sales, which during 2024 was $9.8 billion. Here again, you have the food and paper, you've got the labor, and you have the facilities or occupancy types of costs. So altogether, at the restaurant level, it costs them about $8.3 billion to earn this $9.8 billion. So you have about a $1.5 billion contribution margin to the corporate office. So this is about 14.8%. Now, this is important to understand. McDonald's is the standard bearer. So typically a fast food restaurant is going to have a 15% contribution margin at the restaurant level to the corporate office. So this is going to be true or should be true for all of the members of the fast food industry. From that contribution margin is subtracted depreciation and amortization, its share of interest for the debt that the company incurs, and of course the taxes. When it's all said and done, of this $1.5 billion, about $500 million is the actual net profit that these McDonald's owned locations contribute to the overall net profit. So in 2024, McDonald's net profit was 8.2 billion. So 500 million of that 8.2 billion came from the company operated stores. Now, in this industry, on their financial reports, they use a particular presentation format. So here, this is an example of Starbucks presentation format. Again, one of the line items will be company operated locations. So here you can see within with Starbucks, it's 30.7 billion. You have almost 4.4 billion from licensed stores. They don't use the word franchise; they use licensing as the terminology. So these are the royalties that are being paid by these franchisees, and then of course there's this other line called other income for a total of 37.2 billion in revenue is what Starbucks received in the year 2024. Now, other refers to typically technology fees that they charge their franchisees. It also includes online sales. It includes grocery product sales. So, for example, when you go to the grocery store, you'll see Starbucks coffee on the shelf. You also will see McDonald's because this is their particular brand that they sell at the grocery store level. So that's what is covered inside of other sales. So now let's go over to McDonald's financial statement and take a look at their report. Just like Starbucks, McDonald's has three segments of revenue. They have their sales by the company operated restaurants, so I highlighted this in yellow at $9.8 billion. And of course, these are the associated costs for those company owned locations. Remember, they contribute 15% margin of their sales to the overall operating profit, which in this company is 11.7 billion. So basically, 12.4%. All the operating profit was made by the company-owned locations. There's other revenues, again, those technology fees, grocery store sales, etc., for 423 million. Now look at the franchise restaurants. This segment of revenue. This is $15.7 billion. So unlike Starbucks, which is dependent on its company-owned locations for its revenue section, McDonald's franchising is their main source of revenue. And so now what we want to do is let's dig into the franchising sector to determine how that is derived. And so what we're going to do here is I'm going to go over here to this report. So this is the $15.7 billion of revenue generated by the franchising segment. This is subdivided into three sub segments. There's the initial fees, $92 million. These are the startup fees that they charge new franchisees. McDonald's is growing at 2,000 restaurants per year. Their goal is to be at 50,000 restaurants by the end of this decade. So this line item right here is going to probably be in the $100 million range year after year after year as we go through the balance of this decade. Royalties is at $5.6 billion. Royalties is a 4% fee that McDonald's charges its franchisees. Typical in this industry, franchise fees range from as low as 4% to as high as 9%. Dairy Queen is one of the biggest ones because they charge between 7 and 9% because they add a marketing charge onto their royalty fee. But look at this. Yeah, I have circled here in red. Rents are $10 billion. So remember, the main income statement here, the total revenue here is $26 billion. and of the 26 billion, rents from the real estate is $10 billion. So what is happening here? McDonald's is going out and leasing property from landowners and in turn subleasing this to franchisees. They're going out and selecting the best sites for McDonald's location. Exits off of highways, growing towns, etc. And that's what they're doing is they're creating the best possibility of success for a franchisee with their location. What's important here is I've highlighted this in yellow up in here, and this is in the franchising notes where it says franchise arrangements. So basically, in these lease arrangements, they have a 20-year lease with the landowner and with the franchisee, and then of course they have one-sided options to renew for 2 more 20-year segments. And at the end of the 20-year, McDonald's owns the real estate or owns the rights to the real estate, and of course the equipment and the building on that particular land. So this is a great deal for McDonald's as it relates to being a landlord in the overall scheme of things. Furthermore, I've highlighted in red something that's really fascinating, which is uncommon, even at the commercial contract level for leases, where the franchisee is responsible for all the occupancy costs, including property taxes, insurance, and site maintenance. So the franchisee is held responsible for this. This comes into play in this next presentation I'm going to have for you. I'm now going to take the franchising segment of revenue for McDonald's, that $15.7 billion, and break it down into a line item for the 3 sub-segments of what they're generating in revenue and, of course, the associated costs with generating that revenue. And up in here, you can see this. I have the rents at $10 billion, royalties at $5.6 billion, and of course $100 million in the initial franchising fees. So for a total of $15.7 billion. The costs associated with the rents are about $3 billion. This is the money that McDonald's is paying to the actual owner of the property itself, plus some depreciation, etc., is allocated into this $3 billion. Royalties has $2.5 billion. Of course, they have McDonald's does quality control checks, marketing campaign, etc. is involved in this $2.5 billion, and there's about $40 million in the initial fee structure for franchisees. So total cost for this particular segment of revenue is $5.5 billion. Look at the profit that this segment generates, $10.1 or almost $10.2 billion of the operating income, which is $11.7 billion, is generated just from this one segment of revenue. And of course, if you come down in here, I'm breaking this $11.7 billion down furthermore into the 3 sections. Again, $10.2 billion from franchising, $1.5 billion from the company operated stores, which we just covered earlier, and then about $104 million from those other fees for a total of $11.7 billion. This is important to recognize the allocation of the contribution margin from these different segments of revenue, because what you're going to see in the next section is this is going to illustrate for you how they generate again to the final profit at the end of the day. What's happening here is that what you can see is that franchising alone is generating 69% of this franchising fee is coming just from the rents. So because it's disproportionately strong in the overall revenue spectrum, that the rents are dominating the overall financial posture of McDonald's. And you're going to see that here in just a moment. Before we move into calculating and determining the next 10 years of profits that this company is going to generate, you first need to realize or understand how this shift in this business model's shift towards real estate is going to really benefit the company overall. First off, I said there's $11.7 billion of contribution margin. From this $11.7 billion, we're subtracting about $3.6 billion for income taxes and interest. Interest is about 1.5 billion, and then the balance, the other 2.1 billion, is of course taxes that they pay to the various states and to the federal government. Allocating 70% of these two line items to the rents, which is, again, rents are only 69% of the franchising element, 58% overall, 54% overall of the contribution margin, yet they're getting a stronger allocation assignment of the interest and the taxes, still means that the franchising, the rental element, the real estate element of the sources of revenue is contributing almost $4.5 billion of the $8.2 billion in profit in the year 2024. This is 54.4%. So this is a big deal. And the reason I'm going to explain this is I want you to see that, you have a division or a segment of revenue coming into your company that is basically 38.6%, yet it's producing 54% of your bottom line. So this tells you that this particular segment is strong. Go back to when we talked about the operated stores, the company operated stores. I said that they're delivering about 500 million of the 8.2 billion. So, that's not just a little over, that's about 6% of the bottom line is coming from that $9.7 billion. And yet on this $10 billion item, we're contributing 54%. So you can see how profitable rents really are to McDonald's. Now I want you to see how much it has grown over the last 18 years. And back in 2007, it was $2 billion of rents coming into the company. It was only 9% of the total revenue. Its margin was about 1.5 billion, and it was about 36% of the profits back in those days. It has grown over time into 2024, where it is now 54%. I expect that this particular arm or division of this segment of revenue, franchising segment, subdivided into those to royalties and the rents and of course the initial fees. The rents alone are going to become dominant in terms of the overall profitability to the tune of about 58% over the next 10 years. That's how much it will contribute to the net profits of this company. And that is because you can't get it to 100%. You can't even get it to 80% because there's a law of diminishing returns. And because you have other segments of revenue, they're all going to be contributing towards that bottom line. However, rents, no doubt about it, is the dominant contributor towards the bottom line. This helps the company become more recession-proof. And what do I mean by that? Well, what happens is in a recession, your franchisee at his little store still has to make his rent payment at the end of the day. So McDonald's is going to record that rent payment as income, and of course, it's going to continue to contribute to the bottom line. However, they may not receive it in the form of cash. Okay, so what McDonald's will do is they will allow their tenants to defer a portion of their rents to the end of the recession, and then make them start paying it back in incremental installments. So over the course of about 10 years, even with the recession, the total cash coming into the company will be there, but the profits are going to be maintaining at the relatively higher level because these profits are more dependent on the real estate than they are on the royalties. So even if the economy dropped or went into a recession for a 3-year period, I suspect, based on my math, that even in the worst year, you're talking about $1.5 billion of a reduction in net profits. And so think about this for just a minute. Profits in 2024 were $8.2 billion. I expect the profits in 2025 to be a little over $8.6 billion. So, you take a recession situation, subtract $1.5 billion from that, you still have a company that's generating $7 billion of net profits even during a recession because of this heavy reliance on the rents. I pulled together pertinent data points that is important for all viewers to understand and understanding how we're going to calculate the next 10 years of profitability for McDonald's. I want to point out four key points from this particular spreadsheet. Again, this is that downloadable document that I provided as a link in the description below. Number one, notice how the revenue has flipped from company-owned locations to franchising over the last 18 years. You can see that also with the number of stores, company-owned stores. There were 6,500 back in 2008. Today, there's 2,050. What this has done is because the company is shifting towards that one element of rents as becoming the dominant profit generator for the company, the net profits for the company have doubled in the last 18 years, but the revenue has only gone up 3.5 billion. But the profits have gone up over $4 billion in that same time frame. And then the last thing I want to point out to you, and I have to move this over so you can see this. You can see that in cells T7 and 8. The total profits or earnings during these last 18 years is 105.3 billion. The cash flow is 129.2 billion, and this is because of the situation related to depreciation and amortization being recorded on the books of record. And of course, when you add that as a cash element back, you can see that the total cash from operations is a factor of 1.2 of earnings. And now this comes into play in terms of determining profitability into the future. So I'm going to flip over to my next presentation, and you can see on your screen as a graph. Look at the net income as a percentage of total revenues. Back in 2008 up through 2015, net profits were below or right at 20% or below. But since then, they have jumped because the company is flipping towards real estate as the dominant element of overall revenue. The profits from that are relatively low because the costs are low. Again, $10 billion in revenue from rents, $3 billion of costs. You got a $7 billion contribution towards the overall operating profit. And of that $7 billion, $4.5 billion ended up on the bottom line for the company. This has shifted its profitability higher, dramatically higher. It is now at a different level. We're getting above 30% over the last 5 years. You can see that contribution is there. It is very dominant. So this comes into play in determining the next 10 years of profitability. Again, in order to do that, you have to have three elements. You have to be able to understand the volatility of the earnings of a company like this. And in this situation, that volatility has dropped dramatically. Odds of it going up or down dramatically is going to be relatively low. It's going to be relatively steady as we go through the next 10 years of sales for this particular company. So that's number one. So volatility is low. Number two is you should be able to predict the next net earnings, and you should be able to predict that the percentage of profitability for the company over the next 10 years. So I'm going to flip back to the graph that I was showing you from before, and I'm just going to pause here for just a minute because I'm going to pull up on my screen some information. So what I want to do is, let me get this. All right, so this is a little summary of what's happened over the last 10 years and how we're going to predict into the future what the profitability of this company is going to be. You can see in the last 10 years, we had $233.5 billion of revenue. You can also see that I'm projecting about 275 during the next 10 years. And this is assuming a 3-year recession where sales are going to drop, the food sales are going to drop. But remember, the rents are not going to drop because, again, McDonald's will allow its franchisees to defer parts of their rent into the future, but the overall cash flow is going to stay the same at a factor of 1.2 over this 10-year period, because it's only a 3-year recession. At the end of the 3-year recession, McDonald's will again pick up the receipts through the deferral of those some of those portions of the rents that were due to them, because they'll carry them on the balance sheet as a receivable. And then ultimately those franchisees will pay those rents to McDonald's into the future. So the overall cash flow over a 10-year window is going to maintain relatively at the 1.2 factor of earnings. So the total profits, assuming a 29% profit margin. Remember, last 5 years has been 31, 30, 31, 32, and even as high as like 32.5%. But even at 29%, you should expect total net earnings in these $80 billion over the next 10 years, assuming the growth, the addition of the 2,000 restaurants per year, getting to 50,000 restaurants by the end of the decade. Now, if this profit margin jumps to 32%, we're looking at about $88 billion of profits over the next 10 years. So the final answer is going to end up somewhere between this 80 billion and this 88 billion. It is possible it could hit as high as 92, 93 billion dollars, depending on how fast they can get to the 50,000 restaurants, how the contracts are signed, whether there's an economic recession or some type of consumer issues that happen out there. There's lots of factors that come into play in this. But in the overall scheme of determining profitability for this company over the next 10 years, you're looking at somewhere between 80 and $88 billion. In this chapter, I'm going to illustrate to you how the board of directors for McDonald's has shifted the focus to shareholder returns. And they've done it in two ways. Basically, shareholders receive, the most common way people understand it is dividends, but they also buy back treasury stock from the folks out there. So what that means is that the company, right now, about 75% of the company is held by institutional investors. These are everything from banks, retirement funds, insurance companies, nonprofit organizations, state-run retirement plans, and so forth. So these institutional investors currently hold about 75% of McDonald's stock, which is really a very strong portion. So about 25% of the stock out there that's out in the market are held by individuals like you and I, like my son, who has his one share. These are the folks that normally trade every single day. So right now, about 3.5 million shares on average swap around each day. People buy, sell each day. Some of that activity is tied to institutional investors, not very much of it. The bulk of it are these individual shareholders that are out there. So I want to illustrate to you why this is so important, why McDonald's is doing this, and how does it impact you as an investor. So let's take a close look at this thing. In order to do this, we have to go back in time. So I'm going to go back to 2006, at the end of 2006, and I want to show you something here that's on the screen. So I'm going to move this thing. You're going to see right here. So this is their balance sheet that you can see right here. This is 2006. And so what's going to happen is let me move down in here. At that time, there were $29 billion in assets. And as we keep moving on down, I want to highlight a couple items to you. Okay, so the first thing here is I want you to see something that's really important here. At that time, the equity section of the balance sheet, which is the shareholder portion of the ownership of this company, what's its monetary dollar value on the books of record for this company. So at that time, it was basically $15.5 billion. So if you look at the details, so let's dig into this just a little bit. You have one show you how to read the balance sheet. This is the shareholders equity section right here. It says here's the common stock, and you can see that the company has authorized $3.5 billion. I'm sorry, 3.5 billion shares, which means that they could sell into the market 3.5 billion shares. They have issued, which means they have sold out into the market 1,661,000,000 shares. Now, up to that point in time, McDonald's has bought back, they use the term treasury stock. So they have bought back 457 million of these 1.6 billion shares. So currently on 12/31/2006, there are in the market 1,204,000,000 shares at that time. All right. So now let's move fast forward to 2024. Long one. Here we go. Now what's happened in 2024, so I want you to be able to see this. Look at the shareholders' equity position. It's a negative $4,000. If you go back to 2006, it's a positive 15.5 billion with 1.2 billion shares out there. Each share is worth, you take 15 billion 458 divided by 1,204,000,000. So each share is worth about $12.83. That's the book value of each share on McDonald's books. That's what it's worth. When you go to 2024, you'll notice that the equity position is minus $4 billion. And again, they have 1,661,000,000 shares issued out in the market. At this point, you'll see down in here the treasury stock, 945 million shares have been bought back. They have bought back like 400, and I think it's like 490 million shares have been bought back by this company since 2006. So right now, there's only 715 million shares out in the market that are being traded. And again, only 25% of this 715 million shares that are in the market at the end of 2024 are actively being traded. These are the individuals. And again, it's about 3.5 million shares are moving around each day. So the ownership is not really changing a whole lot. But what has happened is McDonald's has consolidated the number of shares out in the market. So that what's happening is these institutional investors, by the fact that they're continuing to hold their positions with where they are, okay, are gaining greater and greater control of McDonald's. They're the ones that are electing certain board members, and they are advocating for dividends and buying back stock. Now, last year, in 2024, McDonald's created their next program with a shareholder buyback. They authorized $15 billion to buy back as many shares as they possibly can. Over the last year, they have spent some money on that. I think it's like, if I remember correctly, going through the financials, it's been about 1.5 billion shares. $1.5 billion has been spent. $1.5 billion has been spent, and they have bought back about, I believe, 5 to 6 million shares. So I'm expecting when the annual report comes out in late February, early March of 2026, that the number of shares out in the market is going to be somewhere right around 709, maybe 710 million shares exist in the market. This book value at the end of 2024, with 715 million shares, is a negative $5.30. So in accounting, we call that being upside down, and you can see that right here. If you look, you can see there's $55 billion of assets on the books of record for McDonald's at the end of 2024. Again, here's December 31st, 2024, $55.2 billion in assets. There are basically $59 billion in liabilities. These are accounts payable, long-term debt, etc. Okay, that's the total combined liabilities are $59 billion. The difference is a negative $4 billion for the shareholders. So what's happened is McDonald's has basically liquidated as much as they possibly can in the company in order to buy back as much stock as they possibly can. Now, why would first off, why were they doing it? Again, it's because they're trying to give more and more control to these institutional investors. They're trying to eliminate as many individual investors as they possibly can. They're trying to control the pool of stock that's out there in the market. That's number one. Number two is they're driven to return as much value as they possibly can. Remember, from the income statement that I showed you earlier, or the data file that I showed you, they have basically, of the $129 billion of cash that they've brought in over the last 18 years, they have distributed out to the shareholders through dividends and this treasury stock, the buyback program, 128 billion of it. And they're going to continue to do this, at least for the next 5 years. So this comes into play a pretty big deal. So in order to do this, McDonald's did something that kind of elevates the risk of the company, but I'm going to show you something fascinating here about that. So in order to do this, McDonald's basically had to also borrow money in order to expand the company. Okay, in order to grow this company, to add all these extra restaurants, these lease obligations, build these new restaurant structures, put in the site development work and so on, they had to borrow this money. So let me show you how this happened. So first thing is I want you to see that at the end of 2024, there is this long-term debt right here. See? Right there, it's $38 billion. Now let's flip back to 2006. And what was the long-term debt then? $8.5 billion. So basically, again, $8.5 billion at the end of 2006, going into 2007, it has grown $30 billion over the last basically 18 years. 19 years, it has grown $30 billion. Now, I know all of you are going like, what in the world did they do with this $30 billion? Well, part of that was used to, again, to take this to a negative equity position in the company. But the bulk of it is right up in here. You can see it. Let me move my screen here so you can see this. See where it says lease rights, lease right of use assets? This is where they're going out to those landowners and getting the lease rights for a piece of property for the next 60 years. Look at this, $13.4 billion over the last 17 years, because if you go back to 2006, you will see there are no assets called lease rights. None. It's not there in the balance sheet at all. So they don't really own any lease rights back then. They did have some. It's included inside either in this property and equipment or what they call the investment into affiliates. All right. But so they had some, but that program, again, remember I said it didn't kick into gear until the year 20. It really started kicking into gear in the early teens, is where it really ramped right up to what it is today. Another thing that happens is you'll notice that back then, net equipment was about 20.8 billion, and today, because you have to buy equipment in order to do these restaurants, we're up to $25 billion in terms of net equipment. Again, you can see total face value on that equipment was $44 billion today. Face value back in 2000 and at the beginning of 2007 was 32 billion. This is 31.8 billion right here. So face value then was 32 billion, and then today it has grown to 44 billion. So you need cash in order to buy that type of equipment that's out there. So they're doing it through the function of borrowing money. So now that kind of elevates risk a little bit. Now I know each of you are going, well, that's kind of dangerous, Dave. Not really. Watch. This is the debt financing document or notes to the debt that the company actually has. And I want you to see something here. There's a couple important things in here. Number one is the interest rate. Okay, so they borrow this money, and you can see their short-term interest rate is 4.6%. But I want to show you that the bulk of the debt, which is right down here, trying to get my screen to move over a little bit. There we go. So the bulk of the debt, uh, you can see right here, is 4.2%. So 24 billion of the debt is at 4.2%. The rest of it, you can see, is at some of it has almost 1.3 billion of it is at 5.7%. But the bulk of it is, you can see, not the bulk, but a good amount is at lower rates than 4.2%. So basically, McDonald's is paying out about, in the aggregate, because if you look at their consolidated financial statement right here, you can see that when you have $38 billion in debt, or long-term debt, the interest rate that they're paying right here is 1.5 billion. So if you take 1.5 billion divided by 38 billion, the average annual interest rate is actually just slightly less than 4%. So that's really what McDonald's is paying for its debt. It's about 4% per year. Now, to give you some comparative, Walmart pays about 4.4% for all of its debt. So McDonald's is in much better situation than even Walmart is in terms of its interest rate that it's paying on its debt. But there's something else that really caught my attention when I was reading the notes. So, and it's going to be this particular clause right here that I've highlighted in yellow. So let me decrease this a little bit so you guys can see this. Right here. It says there are no provisions in the company's debt obligations that would accelerate repayment of debt as a result of change in the credit ratings or a material adverse change in the company's business. So if McDonald's decided to switch its menu up from the typical chicken sandwiches and burgers and so on to, let's say, hot dogs, the creditors can't call the notes. That's kind of unheard of in business. It's rare. I bet you I can't count. I bet you there's not more than 5 companies in the entire publicly traded realm that have this clause written into this thing. And the reason it's there is because McDonald's cash flow is so strong that creditors are clamoring to lend them money, and they're basically saying, we won't call your debt. We won't call this debt until it's mature. When it's mature, that's when you pay us. And you pay the interest rate in the interim. And that's what's going on here with McDonald's. And that's why this is additional evidence of how solid of an operation this company really is. This call provision is huge in business. And it's really something that's incredible to see. So what's happening is as it relates to the debt situation and what's going on here with McDonald's and how important this is and how it impacts the shareholders. So what's going to happen is in the last chapter I talked about that we're looking at 88 billion. Then you got the multiplier of 1.2 for the cash flow. They're going to have about 105 billion dollars of cash flow over the next 10 years. Basically, all of that is going right back to the shareholders in the form of dividends and treasury stock buyback. I suspect that at the end of the 10 years, there's going to be about 670 million shares remaining on the books as they buy back more stock. And so this is going to elevate the value of those shares over time. It's going to give them support because there's going to be less and less of these shares available to be traded in the market, which gives them more credibility and more value at the end of the day. So that's what helps to support the concept that this is a lower risk type of an investment than what you would commonly see. So now, with all of this knowledge that we have right here that I've stated up to this point and how important this is, we're going to move into the last chapter, which is this investment matrix, because I basically have shown you and illustrated to you and proven to you that, number one, this company is low risk. Okay, it has shifted its business model to real estate, which is really creating additional value for the company because its profits are not going to be as greatly impacted by recession. Or even when people write, stupid comments in social media like, hey, things have changed, their burgers aren't as good as they were, all that crazy stuff that happens out there. Even if consumer confidence drops 3-4%, in fast food or even in McDonald's directly, it's really not going to impact McDonald's like what people think it's going to be. So before going into the investment matrices that exist out there for the various types of investors, I want to cover a couple of items first. The first one is I want to talk about the current dividend yield. So basically, the way that works is right now in 2026, I'm expecting the um, uh, dividends to be $7.50. The current market price for a share of stock is 307. I use 307, but it's right now it's like 312, 314, something like that today. So the dividend yield is going to be nearly about 2.4%. So if you basically bought the stock today as is, just for the dividends, you're going to get about a 2.4% return on your investment. What will happen is the market price for the stock will slowly increase over time. It's been increasing over the last 18 years at about 3.49% consistently over the last 18 years. What that means is back here in 2007, right in here, it was $54 a share was the market price. And of course, you know what it is today. So this comes into play. This is important to understand, comes into play in the investment matrix because this is a basic concept. When you put the two together, you're getting not quite a 6% annual yield from the investment. Now, I'm assuming you hold it for the 10 years. The stock will grow over the next 10 years in terms of its market price. You'll receive the dividends over the next 10 years, and you're going to get a certain value when it's all said and done. And then you take that value divided by what you invested, which is the $315 into the stock, and your average annual return will be just slightly less than 6%. So it's not great, but this is relatively low risk investment. Now there is a chance that the market price of the stock will all of a sudden go to $700. Okay, and you'll get a great return on your investment when that happens. And we're going to cover that in the investment matrices that exist out there. So let's move on down because I want to cover one other important aspect of this because this is critical for our the investment models that I've developed for you. So here's McDonald's stock over the last, I believe it's the last 3 years. Yes, it's the last 3 years. You can see it right here. This is a 3-year look back. Twice during the last 3 years, this stock price dropped to $250 a share. Okay, so it has done it twice. Now, just for uh, importance to understand, this investment is going to keep growing each year. So you can't always say it's $250 is the drop by point or, where I'm going to use. This point is going to increase each year. And it's important to understand that it's going to increase some each year. So you can't use this decision basis for the next 10 years. It's not going to work. You have to constantly be on the alert to elevate it a certain amount each year, and it's built inside the investment matrix, which we're going to go into next. So here on the screen is the PDF that I've prepared for the viewer. You can go and again print it out, or you can just sit here. You can follow it along on your printout, or you can follow along here on the screen. So this is there are basically 6 matrix in here, which is plural is matrices. So this is a set of decision models for the types of investors that exist out there. There's a couple important things that I want you to grasp. Number one, up here in the notes, I say, hey, look, note number one, total dividends over the next 10 years is going to be about $105. So basically, I've looked at the history of dividends. I know they grow at a certain rate. I'm expecting so much to be paid in 2026, and I know how much they kind of grow each year. So I expect over the next 10 years, total dividends paid will be about $105. Growth of the market value in terms of the share price is growing at about 3.8% per year. So I expect this thing at the end of 12/31/35 to be right around $455. Odds are it will be a lot higher than that, but I'm projecting at about 455 will be the market price per share, assuming no splits. That type of thing is going to happen over the next 10 years. So this decision model is based on the type of investor that you happen to be. So let's explore an example of one. So here's a dividend driven type of an investor. You're just buying it strictly to earn the dividends, and that's what you want to do. You're going to earn $105 over the next 10 years. That's an average annual return on your investment of 2.9%. So now think about this logically. I said that retirement funds buy this, widow and orphan funds buy this, and why do they buy this? Because you get solid dividends, you get a good return on your well, not a great return, just an average return on your investment, and it's relatively low risk. But think about this logically. If you are a widow and orphans fund and you buy that, many of these funds that already existed in it, they bought it when the stock price was, low $100. Some of them bought it during the 100, 150 range, and they've just been holding it. They've just been receiving dividends over the last 30 to 20 years, and even prior to that. So, but if you did this today and you started holding this and bought it today, let's say 30 years from now, your yield will improve to about 14% annually. So, because you pay $315 and you're getting at that time, let's say, it's $28 a share, your yield jumps. It really does. So, if this is if you're young and you're 20 years old, this is the type of an investment that you might want to consider this, because it's going to really benefit you when you have this in your retirement portfolio when you turn 65 or 68 when you retire. So that's just one example of a type of investor that exists out there. This particular model has three on the first sheet. So the next one is this day trading. I do not advocate for day trading. I mean, it's so much risky and so on. But really with McDonald's, because it's such a solid investment, the volatility, remember I talked about volatility earlier, just really doesn't exist in McDonald's. So it's not going to just, go crazy in one single day. Now, there will be days where you're going to get some social media post where somebody got sick off of a, French fry or whatever it happens to be. And then all of a sudden the stock's going to drop. But we're not talking about, $10, $12, $15. On a worst day, it might drop like $8 because somebody wrote something really negative about the company at that time. Other types of folks that I want to cover is, the more logical one is what I call the active trader. Let me get down here to the active trader. That's this guy right here. And so with active trading, what's going to happen is you want to buy the stock not at the current market price, but you want to wait for the price to drop. And it does drop. Remember, I showed you that that 3-year spreadsheet where the price even, twice it dropped to 250. But as an active trader, you're not waiting for it to go that deep in terms of the price drop. You're actually waiting for it to drop like $10, $12, $15 a share, depending on, who we're talking about, what's happening here. You want to make sure you want to capture this when it's going to happen frequently, because frequency is the key to your success for the active trader. So you're going to be buying it because you're seeking about a 15% annualized return off of your investment. So typically an active trader will pay, let's say, right now I calculated at 303. You should expect to hold this for about 3 months. You're going to get $1.86 in terms of because that's the current dividend that they're paying. You're going to sell it at 312. So what's going to happen is the price is going to drop to 301. You bought it at 303. The price shows back up to 314 within the next 3 months, but you're selling it at 312. So odds are you're going to be able to do this every single quarter as an active trader. You're going to make like $9 off the trade. So that's going to be your capital gain. Altogether, you're going to make 1086 because you're going to receive a dividend check. Now, odds are, you could do this in a 2-month period, which means that you're going to get your capital gain back, but you may not earn that particular dividend, but you did do it in less than 3 months. So when you do this and you base it off of the 3-month cycle, this is a 15.13% annualized return. So what's happening is if you do this 4 times in a year, you're going to get a return of about 15%. So I put some notes in here. The risk, first, the risk of the loss in the investment really is just non-existent in it, because this is a highly stable, very solid type of investment. Even if you invested the 303 and the market price dropped to 250, don't be stupid. Don't sit there and sell it, unless you absolutely have to get your cash back. And then I would just tell you as an advisor, if I were advising you, like, why did you buy it to begin with? You didn't have the cash, available. You always need to have cash on hand as an investor. But basically here, what's happening is the risk is very low that you're actually going to lose all your money. I mean, McDonald's is just not going to go out of business. It would actually take McDonald's at least 10 years to basically liquidate the company, because there's so many contracts out there and what's going on. It would take at least 10 years for McDonald's to liquidate. This isn't something that's going to happen overnight. There's a lot involved. So basically, the company is not going to go to zero. I mean, let's be serious about this. So the return. The price could drop quickly, and but you bought at 303, and then you're going to get upset because, oh man, look, the price went down to 265. I could have bought it at 265. Yeah, but your mindset is active trading, so you're gonna do this frequently is what's happening here. And so just you have to be mindful of this, that you're not going to get super duper returns. Actually, everybody out there that's listening to this video, this is not an instantaneous high return type of an investment. This company is rock solid. It's low risk. And in the overall scheme of things, it's low risk. And so you have to be honest with yourself. Everybody recognizes this name. Everybody recognizes this brand. Everybody recognizes that this is a solid company. This is a solid investment. So volatility is not going to exist in this thing. Downside, low volatility. Upside, low volatility. Let's just be straightforward about this. So, basically you're going to get about a 15.13%. Again, this sheet is designed over a course of, the 6 different types of traders, and it helps you to understand your buy sell concepts depending on what type of a trader you are, and how it's going to work for you. But at the end of the day, let's be realistic here. McDonald's is a low volatility stock. It's not going to be instantaneous loss of money nor an instantaneous gain in money. Many investors have a hard time dealing with that because they want instantaneous gain, and it's just not going to happen here. And I've shown you that their profits each year, 42 years without losses. They're highly oriented around that real estate model. They're going to be profitable year after year. They're going to generate the cash flow over the 10 years that we talked about. So this is a situation where you have to be willing to be patient and smart with how you're going to invest your money over, as you deal with McDonald's. McDonald's is a solid company with a very strong cash flow from operations. I illustrated how the real estate element solidifies profitability and will continue to produce profitability during economic downturns. Furthermore, the board is all about rewarding shareholders. It is an ideal buy and hold just for dividends. There will not be any kind of instantaneous reward for one's investment. I have provided a decision set of matrices depending on your investment style. With good information comes the ability to make wise decisions. If you like this kind of financial analysis, hit the subscribe button or make a comment. It is the only way I'll know to keep making more. In the next episode, I'm going to go to the other end of the spectrum of financial quality in the fast food industry. Here, I'll talk about a company that has a good tasting burger, yet, financially speaking, has a business model that simply will not work. Furthermore, it has earned less than $2 per share over the last 12 years, and the market price is off the charts. To me, it is high risk, and honestly, it is perplexing as to why this company's stock is so overpriced. I'm talking about Shake Shack. It is great to have knowledge, but in order to accumulate wealth, you must act on that knowledge.